What's going on, YouTube? If you were watching this video, you were trying to keep your fingers safe and get financially fit as fast as possible. Well, it takes time, but after this video, you'll be 6 minutes closer or so to a lifetime of financial fitness and being sure of how your money works and just being financially healthy in general. So let's get started. The topic of this video is 3 huge mistakes that beginner investors make. Now, I know that's tailored a little bit towards YouTube. It's kind of YouTube-y, you know what I mean? 3 mistakes. What if it's 4? I feel like I might have made 6 or 7 mistakes when I started investing last week. Okay, yes, part of the reason why I make it only 3 things is YouTube kind of likes that number thing. But I really think that these 3 are the pillars of error when it comes to investing. So the first 2 are kind of weird. They kind of counter each other out. So hear me out here before you exit through this video. So the first reason is investors don't start early enough. But the second reason is investors start too early. So those 2 reasons, those 2 big mistakes that investors make. So let's talk about how those 2 contradictions are even possible. So let's talk about investors who wait to start investing. A lot of times we wait for opportunities to happen in the market. We're waiting for a stock market crash or something like that. But the science, the data, the history says that most people, when they see the stock market crash 10%, 20%, 30%, guess what they do? They put all their money into the stock. I'm just kidding. They don't. They keep on waiting for things to get worse. When the pandemic started in 2020, stocks fell 34%. A lot of people were like, hey, it will get worse. In 2008, there was no pandemic. Stocks fell about 48% at their lowest point, meaning people's portfolios got cut in half. So obviously, when the whole world is experiencing a pandemic, 34%, a third of people's portfolios cut in half, that can't be as bad as it gets. I'm gonna wait for it to get worse. Wrong. It turns out the stock market skyrocketed, your money was doubled in less than a year, and the party kept on going. So, waiting for stock market opportunities is gonna cost you stock market opportunities. Here is a famous quote from a very powerful investor and well-loved and respected Peter Lynch. He says that more money is lost waiting for stock market corrections than during stock market corrections. So then, that being said, how could the second mistake be that new investors wait to start investing if that's kind of like the opposite of what I just said? Well, here it is. The mistake is that they start too early. Yes, I fumbled my words up just a little bit. But they start too early. What does that mean? If it's better to have your money invested as long as possible, then why would waiting be a good idea? Well, here's why. Most people who are not financially fit, they accrued a lot of debt in their lives. So this debt is actually reverse money, right? We got regular money, we got growth money, that's stocks and crypto and collectibles and all that. And then we got backwards money, reverse money. This is money that goes to other people, and it's usually even more than we expect it to be. So if you owe someone $1, you're probably going to pay them $1.20 because of interest. Sounds intriguing or interesting. If you like that pun, please like this video. I'm putting on a show for you, and I hope you enjoy it. Okay, back to the program. So, if you have $10,000 in debt, and it's high interest credit card debt, and you don't pay it off for whatever reason for, let's say, 10 years, 20% of interest, I'm looking at my screen, you will be owing them $61,000 after 10 years. Now, the stock market is great. It's fantastic. But it is not going to outperform the rate at which you have to pay credit card debt. That is a fact. Now, you may get lucky, you may gamble in a couple of stocks and beat it, but we're not investing to gamble. We're not doing this to get lucky. We're using science, data, and history. So when it comes down to it, your stock market investment would have only grown to about $25,000 in a 10-year period if you started with $10,000. That is way less way less than simply paying off your debt and avoiding paying all of that interest, which would be a total of about $60,000. Now, I know that's not truly how credit cards work. It's just a rule of thumb and a quick little estimate, and just so you can have two numbers to compare, 60K or 25K. I'm going with the 60K, paying it off, make sure that I don't pay and get into bigger debt ever again, especially high interest debt. Now, debt itself is not a terrible thing. Many people use it strategically, but for the average person, wait, you guys are not average people. I'm so sorry. You guys are slightly above average. But when it comes to investing, it is totally okay to be completely average. You know what I'm saying? Actually, I look pretty good if I say so myself. I should edit that out. I don't want people thinking I'm overly confident, like the stock market right now. Oh my gosh, what a great opportunity. No. Hold on. I said we'd finish this in about 6 minutes. So we're on minute 6. The third mistake that a lot of beginning investors make is they start thinking about stocks and bonds instead of accounts which to invest inside of. So we got the brokerage account. That's pretty much your Robinhood account. We got the 401k, 403b, IRA, Roth IRA, and so on and so forth. So it does matter where you buy the stocks, and that depends on your goals. So I want you guys to either wait for the next video, look up some of my previous videos where I talk about these retirement accounts, or do some research on your own about the differences between 401ks, Roth IRAs, and brokerages. And let me just tell you right now, since you're already here and you made it to the end of the video, it is taxes. And with that being said, certain accounts you won't pay taxes, but the catch is your money will be in that account for a longer period of time, which is not necessarily a bad thing. So with that, like, comment, subscribe if you'd enjoyed this, and I will see you next time.